PhillipCapital Experts Talk. My name is Lindsay from Phillip Securities Research. Today, we are privileged to have Ms. Olga Yangol, Vice President, Senior Emerging Markets Debt Product Specialist from HSBC Global Asset Management, to share with us some of her near-term prospects on the emerging markets debt. Ms. Olga is a product specialist for the emerging markets debt capabilities. Prior to joining HSBC, Ms. Olga worked as an account manager at PIMCO, where she managed 23 large corporate relationships with $15 billion in AUM across multiple asset classes, with in-depth focus on emerging markets, asset allocation, and hedge funds. Prior to this, Ms. Olga was an executive director at CIBC World Markets, responsible for interest rates, foreign exchange, and equity derivative structuring and sales, working with corporate and private equity clients. Ms. Olga has 9.5 years of investment experience and holds an MBA from MIT Sloan School of Management. She received her undergraduate degree from McGill University. Ms. Olga is a CFA charter holder and holds Financial Risk Manager and Chartered Alternative Investment Analyst designations. Thank you, Ms. Olga, for taking time to attend this interview with us. According to the International Monetary Fund, IMF, the global economy is expected to expand 3.8% next year, below the boom years of 2004 to 2007, when growth was at about 4.9% or even more, while growth in emerging markets has dropped from highs of 6 to 7% a few years ago to around 4.4%. Could you share with us a near-term view on the emerging markets against the background of a dim global growth prospect?
Indeed, what we've observed is has been quite a divergence in loan growth in some of the countries around the world. If we look at the advanced economies, only the US and UK look rather solid, while Europe and Japan are struggling with deflationary pressures. And in emerging markets, China is slowing while India seems to have turned a corner. Really, what happens going forward will depend on a number of things. But for emerging markets, the future is very much dependent on what happens in the US through the link of monetary policy in the US and the impact on emerging markets, and also what happens in China through the link on commodity, the impact on commodity prices, and what that may mean for commodity exporting and commodity importing countries. Looking at the US, it is hard to deny the strength of the US economy. Whatever economic indicators you look at is showing that the economy is really running on all cylinders. Employment is strong. Employment rate is only 3%, 3 decimal points away from the long-run equilibrium level at 5.8% versus 5.5%. Manufacturing activity is at 3-year high. Retail sales are running above historical averages, and consumer credit is growing at over 9% versus historical average of 8%. In terms of growth, the numbers are very strong. Of course, the Federal Reserve is focused on inflation as well as growth when they decide whether to increase rates. And inflation has been running lower because of the impact of lower commodity prices. However, the Federal Reserve is focused on core inflation, which is excluding energy and food, and core component is actually impacted significantly by what happens to wages and consumer credit. And as I mentioned, on those fronts as well, there are inflationary pressures that are emerging. Basically, in our view, the Federal Reserve may have to raise rates sooner rather than later to prevent inflationary pressures from translating into actual inflation. And that will be a headwind for emerging market economies. And with respect to China, indeed, we've seen significant deceleration in construction activity in China, and that raised concerns about what that may mean for commodity prices and hence for commodity exporting economies. And we believe that given the deceleration in the real estate sector and also the government's own efforts to rebalance the economy away from investment to consumption means that commodity prices are not likely to be supported going forward. So really these two major external challenges, withdrawal of liquidity by the Federal Reserve and also lower commodity prices, will mean that growth in emerging market economies will be impacted to the downside. However, all will depend on policy response in these countries. It will all depend on whether they introduce the necessary reforms, and also it will depend on the countries. Some countries may actually benefit from lower commodity prices if they are importers of commodities.
As you mentioned before, as most of the EMs are actually trade-reliant economies, in your view, what could potentially be the main growth drivers for the EM in 2015, given a sluggish external demand?
So indeed, what we've seen is that many emerging economies benefited from rising commodity prices, and as a result, their terms of trade or ratio of exports to imports have been improving. I'd say for a significant period of time since the beginning of this century through 2010, 2011, when commodity prices peaked. However, post that period, we actually have seen the external position of many emerging market countries deteriorate. And on average, the current account balance for some of the major high-quality countries turned from plus 2% in 2006 to about minus 3% now. And that was really a result of some of the more relaxed fiscal policies and more aggressive investment in the private sector. Going forward, with the decline in commodity prices and withdrawal of monetary stimulus by the U.S., there would need to be adjustment. There needs to be an adjustment in emerging market countries, and if the really several options that they will have to tighten fiscal policy or actually lower investment, which would be negative for growth. However, it will help them adjust any unsustainable external imbalances, or they may need to depreciate their currency. And depreciating the currency would actually be the easiest solution. The way that mechanism works is a weaker currency slows down imports, and it helps close that gap and actually helps also growth, given that imports actually detract from overall GDP growth of a country. And those countries that are actually able to implement structural reforms that could increase the productivity of a country or stimulate rebalancing of the economy, such as in China, from investment to consumption, or in Brazil, away from consumption to investment, it will also make all the difference.
As you have mentioned before, the current monetary policies across the world are actually diverging, and the US dollar are actually trending higher. Could you also share with us your investment strategy in terms of yields as well as exchange rate?
At the moment, we are cautious overall in emerging markets. However, we believe there are pockets of opportunity. We believe that the currencies of many emerging market countries will continue to weaken over the medium term. As I mentioned, it's due to some of the external pressures and in light of the imbalances externally that some of these countries have. We are more constructive on the dollar-denominated debt of emerging market countries, particularly in high-quality countries that have high reserves, relatively low external debt outstanding, floating currencies, which they could depreciate and which can act as a shock absorber against external challenges, and also a responsible mix of monetary and fiscal policies. These countries include Mexico, Colombia, South Africa, and Indonesia, for example.
As concerns on coal and iron ore good, as well as the plunging oil prices weigh on investor sentiment, could you comment on how the falling commodity prices affect EM bonds?
The effect depends on whether the country is a commodity importer or exporter. And indeed, many emerging market countries are exporters of commodities or oil. For example, Russia's exports, 2/3 of Russia's exports are energy related, and 50% of Colombia's exports are in oil. However, some countries are actual importers of some commodities in oil, for example, India or Asian economies or South Africa, for example. So the impact will depend once again on whether the country is an exporter or importer. That is, therefore, we actually in our portfolios shy away from countries that are dependent on commodities and prefer those who benefit from lower commodity prices.
In this higher risk environment, in terms of when Europe as well as Japan's economy are moderating, in particular Japan's economy, which actually plunged to recession in the previous quarter, how should investors position themselves? And what are the investment opportunities which investors can look into in terms of region or countries, asset classes or sectors?
Within emerging market space, we believe that investors would have to be highly selective and pick the countries that are in a better position to withstand some of these challenges. We believe that an approach that is benchmark agnostic, as opposed to being driven by what the major indices in emerging markets dictate, is more prudent because it allows investors to start from a clean slate and select countries and companies with the best risk-adjusted characteristics. In terms of countries, I would again, in our portfolios, we prefer high-quality countries with strong balance sheets and floating currency regimes. With respect to corporations or corporates in emerging markets, we tend to currently prefer sovereigns to corporates given rich valuations in corporates and given that corporates have lower liquidity. However, we do prefer those corporates that are either exporters, so they would tend to benefit from weaker currency, or those who have hedged their currency exposure. Also, we generally tend to be underweight countries on the lower quality spectrum, and those who cannot use the mechanisms that I previously described to adjust any external pressures.
Are there any hidden risks in EM debt which investors should be cautious? And how should investors manage these downside risks?
What's important to keep in mind, as I mentioned, is when investing into emerging markets and understand the composition of the fund or the portfolio. In traditional investing, typically managers or portfolio managers manage against a benchmark or an index. However, the problem is that many emerging market indices are issuer focused, meaning that the allocation to each country is based on the amount and maturity of the bonds outstanding. And so as a result, investors get exposed to the most indebted countries and have elevated duration exposure, given that sovereign issuers have a preference for longer dated maturities. In fact, the duration of the main index in emerging markets is 7 years and has been gradually increasing as many countries are issuing 20 and 30-year bonds. So going forward, as interest rates are likely to rise in the U.S., we believe that managing that risk will be highly important. And in also managing concentration risk to some of the countries that may not be in the best position in this environment. For example, in the main index, once again, Russia and Venezuela comprise 15%. Once again, investors may decide to allocate to these countries, but they would have to decide that consciously, not because the benchmark dictates them so. Recognizing the embedded risks of benchmarks would be highly important in this environment.
In addition, with respect to China's overcapacity issues, China's corporate bonds default risk increases. Could you also share with us your views on this matter?
Well, in China, we are actually concerned about all the things that you mentioned, and where we are invested in China is in high-quality banks and quasi-sovereign, state-owned enterprises. In some of them in the property sector, but again, high quality. So, because of that, would actually recommend, to be in a higher quality spectrum.
Thank you, Ms. Olga, for sharing your insights with us here today. For more information on unit trust, please log on to www.poems.com.sg/unit trust or talk to us at any Phillips Securities branches.